Howdy, Jacob here. Today we're looking at the company ANSys, ticker symbol ANSS, company 45, our generic stock screener in the software industry. 28.6 billion market cap on 28.3 billion enterprise value. I can't say I think I've heard of this business before. They develop and market engineering simulation software and services to engineers, designers, researchers, and students in the US, Japan, pretty much globally. I love this is why I love researching companies. You sometimes see businesses that $28 billion, you would think I've heard of that business, and I might have heard of it somewhere. It doesn't not necessarily ring a bell, but I definitely wouldn't have been able to tell you what they did. So that's always fun when you do this when you research businesses. But revenue growth pretty impressive. You're probably looking at 10-11% CAGR over the last 10 years. Gross margin is up. Operating margin, however, is down. So cost of goods sold in comparison to their revenue isn't dampening as much, but their maybe R&D, we'll be able to look at this after this, sales and general admin might be increasing more. But return on invested capital also going down, high single digits, possibly higher than weighted average cost of capital, meaning they could still be creating business here. Not necessarily a terrible thing. I mean, that's still fine. Return on invested capital. Income statement does show a good increase of R&D, but also a lot heavy increase on sales, general, and admin and everything. You take out R&D or even remove half of it, 750 to 2.2, you're looking at, I think, what was that, 35%? Pretty, very impressive margins, but they're really trying to get some growth here, so that R&D spend is, prospective growth, hopefully, as long as they do it well. Capital expenditure is very low, haven't really changed over the last 10 years. They've made a lot of acquisitions with their money, bought back a little bit of shares, but heavy production of their free cash flow goes towards acquisitions, and maybe 20% or so goes towards share repurchases. And good increase in cash from operations, but they do have very heavy stock-based compensation. So much so that their share repurchases are not even, they're pretty much offsetting it. So I just go straight to the assumptions on the stock or share change. I'm just going to go zero. I'm going to say that they do spend maybe 25 to 30% of their free cash flow on share repurchases, just enough to offset stock-based compensation. That remaining 60% or so to reinvest back in themselves, we can see on R&D spend, and then also for acquisitions to acquiring businesses, because that's what they've done historically, not necessarily what we want them to do, but you have to balance out with what companies have done historically with what you actually want them to do. And I mean, they've definitely produced heavy revenue growth with those acquisitions, but we do see operating margin down quite a bit. I mean, not to say 27% operating margin still is extraordinarily impressive, so keep that in mind too. But if we get to our other revenue growth and everything, other assumptions, I think 8% does seem pretty reasonable. Maybe on the higher end, but less internal growth. So that 18 is really, they're going to have a lot of growth out of them at the end of 7 years, probably still for a couple of years. But return on invested capital, not fantastic, and their growth has been really heavily due to acquisitions. So if I wanted to, be very analytical here, I'd have to dig into the business's organic growth and come up with a valuation from there. Because on the acquisition side, they definitely haven't necessarily increased the efficiency, which we would see through increased margins, since we're seeing decreased margins. But again, great increases in revenue and everything. For margins, going down a little bit. Free cash flow I like is quite a bit higher. Let's do a bigger range here, 25, 30. And it needs to fall 76% to get the price we're looking for. Kind of no surprise there, 66 current PE. I said 18 PE in the future. I mean, the growth rate does now substantiate the discount rate. It's really no surprise here. I do think it's a great business, or probably a really good business. I don't know if I'd go great, but it does look like a very solid business. I think their acquisitions are really growing the top line, but I do prefer the bottom line grow as much as the revenue, if not more. You want the company to be becoming more efficient the longer they're a business, the longer they've been around. You want the company to be producing more free cash flow and earnings in relation to their revenue growth, which we aren't necessarily seeing here. But again, I still think there's good growth out of them. They've been solid with acquisitions, so you can't really penalize them because they have been all right with them. But I think it just looks a bit expensive here. So hopefully you enjoy the video. Have a great day. Thank you.